Assembly Committee Room.
This
Michaela Boy.
okay. Going on to the draft minutes then. Pages 5 to 9. Members content their record.
Agreed.
Matters arising, refer members to the summary table request at pages 11 to 14 for noting. Moving on then to the LCM on powers to prevent transfers out of unfunded public service defined benefit pension schemes to defined contribution pension schemes. Briefing from the Department can refer members to a copy of the correspondence between the committee and the Department regarding the timetable for the proposed at pages 16 to 18 of your packs, and a letter from the Department outlining the proposal for the LCM together with a copy of the draft amendments to the Westminster Bill, and these have been provided on an in-confidence basis for the time being. These are pages 19 to 27 of your packs. So can I welcome Blanid Smith and Stephen Ball from the Corporate Human Resources to the committee. Both very welcome.
Morning.
Do you want to make an opening statement on this, where we're at,
a wee bit.
and how urgent it is, and then we'll go on to questions.
Okay, that's great. I'd like to thank the committee for the opportunity to provide an update on the issue at the meeting today. And Chair, if the committee permits, I'll address the concerns raised in the committee's correspondence of the 22nd of October concerning timescales for its scrutiny of the LCM. A formal written response to this correspondence has been prepared and is in the process of being issued actually at the moment. The interim attempt to provide some clarification and outline the approach the Department intends to take to assist in facilitating the committee's scrutiny of the LCM in line with the provisions of Standing Order 42A. I'd be happy then to take any questions. The committee noted in its concerns at the timescale set out in the Department's letter of the 21st of October. At that time, we had been advised that the laying of the amendments in Westminster was imminent, and that they would require a decision by report stage in the House of Commons, which was the 17th of November. The position at the moment is they haven't actually laid these amendments yet. Potentially they will be laying them at report stage on the 17th of November. And it's only at that stage where we can lay the memorandum and then give the committee the 15 days before it's debated on, so that the committee can provide a report if it wishes to do so. The policy has actually still been very much in development. The policy is emanating from the Freedom and Choice of Pensions consultation that was carried out by Treasury. And we had been advised in correspondence where they were seeking LCMs that there could be further issues to be addressed. At the time when we received the correspondence from CST on the 11th of September, there was a considerable liaison needed with other departments. This legislation will amend. It's the pensions bill in GB, and it's a DWP bill, and it will also then be taken forward in DSD legislation here. But we're specifically concerned with a public sector pensions aspect of it. The ban on transfers from defined benefit schemes to defined contribution schemes could pose a significant risk to the public sector schemes. So while DSD may take forward an LCM for other aspects of this legislation to do with giving advice to people, we would be very keen to proceed to ensure that this aspect is legislated for April because of the financial risk to the public sector schemes and then ultimately to the public purse. The Department accepts the need to consult with the committee at an early stage on the policy when an LCM may be considered. In this case, it would advise policy although targeted and impacts for transfers from public sector service schemes. operates within the context of that broader freedom and choice in pensions. The DFP priority here has been the protection and the integrity of the public service schemes and their members in the event there could be a significant run on the defined contribution arrangements under that broader policy. Departmental officials have been engaged with Treasury officials and other departments on the scope of the impacts of the broader policy to define the area where the LCM is engaged. There was consideration that a composite LCM may be the way to take it forward with DSD. As I had said, the necessary amending clauses are still being refined in Treasury, so that gives us an indicator of the preparatory work required to get to this point. And as I say, they haven't actually been laid. I hope that provides some clarification around the timescales. In our letter, we had said that it would be normal for the committee to have produced, or for the decision to be taken on the motion by report stage, because we didn't advise of that at that stage. But at this stage, the amendments are only going to be laid at that stage, so it'll be in the House of Lords, actually. If an LCM wasn't to pass here, it'd be in the House of Lords, where our provisions would be stripped from their bills, if need be.
Just a few quick questions.
Right.
You said that you received correspondence on the 11th of September, but the committee wasn't informed about this until the 22nd of October. Why was there that gap, given the urgency of the matter?
That gap was to do with liaison with the other department, because the letter had actually said that they were still formulating areas. It was highlighting that there could be an LCM required for this area, but we had to decide on which was the best way forward, whether it was for DST to take forward the composite LCM.
And when did you formally receive notification from Westminster on the LCM?
That would have been CST's letter on the 11th, sorry. There was a letter received from CST, and the Minister replied agreeing in principle on 23rd.
So that included draft amendments, did it? Or?
No, we still don't have the actual amendments for this. We have draft amendments, but the latest notification from Treasury is that, as Planet pointed out, they won't be laid until the 17th, and they're still being finalised. We don't actually still at this stage have a final set of amendments.
So at the moment you're not in a position to do anything essentially until...
No, we can't lay the memorandum
We
yet.
can't lay the memorandum. Or Legislative Programme Secretary's advice is that we shouldn't be laying the memorandum until we have the draft clauses on which the memorandum will refer to, or that as near as possible the final clauses.
So just to clarify then, later this month those should pass, and then what is the procedure in terms of the Assembly and the Minister laying the necessary
Once the clauses are available, the memorandum will be laid in the Assembly, and I think it will be referred to yourselves as the Committee of Finance and Personnel, to give you the opportunity to scrutinise and also to make a report if you wish to do so. Following that, the Minister's intention would be to lay the motion or move the motion in the Assembly.
And would the committee have the necessary 15 working days?
Our understanding is, yes, that would be the case.
Okay. Given that the LCM will restrict freedom of choice for members of unfunded public service pension schemes, what are the risks of any legal challenges forthcoming to these proposals?
On the unfunded schemes, we're not aware of any risks at this point.
No risk at all?
We've been speaking with HM Treasury on equality impacts, and that's still being explored.
And with DSO.
Yeah, with DSO as well.
And have you had any correspondence with any of the trade unions in regard to this, or is there any concerns?
We've been discussing it with trade unions on our own interdepartmental groups where we liaise with unions. I think generally the feeling is that they agree in principle with
There was agreement.
safeguarding of the schemes, because there could be detrimental impacts for members if there was a run on any of the schemes that could have an impact on the cost control mechanism for the schemes, which means remaining members would possibly be in a position where they would be faced with higher contributions or modifications to the schemes may be required.
There's also concern expressed about the funded schemes.
The paper also states that Treasury and Revenue and Customs estimate an annual cost of 200 million will be incurred if 1% of those reaching retirement age were to transfer out in order to access their pension savings flexibly. Has the department done any forecasting to estimate what the costs might be here?
That analysis hasn't been carried out
Hasn't been
yet.
done. Have you any rough idea of what the cost might be?
I don't think we have, but I mean, it's could be viewed by some as an attractive option, and there wouldn't be any current controls that would be able to stem the flow unless we take that same action's been taken for the GB schemes.
And in terms of the numbers affected, how many workers are we talking about in terms of public sector workers here?
I'm not sure what the exact numbers are, but I mean, it extends across all the public service schemes with the exception of the local government scheme, where there are being considerations that are being taken. That's where the transfer will potentially be allowed to go ahead. The ban only affects the unfunded schemes where there's a direct link to the expenditure in the public purse.
We're talking over 200,000 people.
200,000. And in terms, you made reference to the Department of Social Development. Has any views been forthcoming from other departments on the scheme? On those changes?
On this particular
Yeah.
policy, not just through the executive paper. As you'll be aware, an executive paper was distributed after the 20th on the 21st, and it was agreed at the executive in principle that they would take forward, that our minister could take forward. So.
Okay. Okay, members, any questions? Raymond?
Thank you, Chair. In the paper from the department, it says that this is in the interest of the scheme members here in the north. How's that the case?
That's the case because although these are unfunded schemes, in a funded scheme, when a transfer value would be calculated, that would be deducted from their scheme. You know, it would be a draw on the scheme. And unfunded schemes, although they don't have a fund, they do have valuations. So it could lead to a severe deficit on the scheme, which would impact the taxpayer, but also scheme members, you know, because it could breach cost controls. When cost controls are breached, you then have to look at employer contributions, employee contributions, and employee benefits. So if there was a great run on unfunded schemes, it could ultimately affect members of unfunded schemes then as well.
Okay, and in the paper it talks about if 1% of the people across the whole scheme opted out. What are they basing that percentage on? Is there an attraction for people to opt out?
There is. The attraction is because of the new rules in the defined contribution schemes that are coming out of this freedom and choice of pensions policy, where there is sort of less tax, where they can draw down. They don't have to buy an annuity, so they can draw down from the pension, and the tax is less than it was in the past. So there is an attraction, and there could actually be a proactive campaign to attract people into DC schemes from their public sector schemes. So.
And no, I mean, if you're someone in this scheme, will they feel that their rights are being impinged by this LCM?
Possibly. I couldn't really answer that. As a member of the scheme myself, I would have to work out whether I would.
Okay.
Yes, there is the possibility of that.
So will there be a sort of equality impact assessment carried out on the LCM?
Yeah, we're speaking to Treasury about what work they've done, and we'll be supplementing that ourselves. We're doing our own work here.
But they wouldn't have a process for...
No, but we're engaging with them on what issues they might have identified, and we're also engaged with our own equality department on what steps we'll take, and that will likely involve an assessment.
Okay, and I mean, in terms of when this was being framed, should this gap have been spotted before the legislation was framed?
In the Treasury policy?
Yeah.
I'm not
If
sure
someone's
whether they
paying,
looked at
say
it.
if someone was paying in the scheme on the basis that they could opt out, when
It doesn't really affect their opportunity to opt out of the scheme. What it's trying to do is to identify that there will be a risk to, I mean, some members will want to stay in the scheme and not transfer to the DC scheme. So there will be a risk to those members, and I think the department's line is to protect the integrity of the scheme overall. And also it will be in line with the initiative for public service pensions, and that people should be saving towards their retirement, and that the scheme provides a good option to achieve that.
Okay, thank you.
Chair,
Deputy Chair.
thanks. When is it possible for people to opt out? Can they do that now, or is it?
Opt out from public service pensions at any time they can opt out.
Right. Okay.
It's
So
actually-
is there, to what extent is that happening
It's negligible at the moment.
at the moment? So, as Raymond said, was this a loophole in the DC schemes or the DC policy that wasn't seen at the time and is now trying to be covered over?
The freedom of choice of pensions is a new policy that they're introducing, and I suppose this is looking to address any impact then on defined benefit public service schemes emanating from that future policy and for DC schemes.
When will the equality impact assessment, when will it be carried out?
We're looking at that now.
All right?
We're looking at that now, and we'll be publishing that shortly,
Will be within the next, what?
within the next few weeks.
They have done equality assessment on the provisions of the pensions bill in Westminster, and we will have it screened here through our equality.
In the next, what, month or?
Yeah.
Yes.
Okay, thank you. Thanks, Chair.
Raymond?
Is that a screening process or a full EQA
But it would have to be screened for.
first?
Just in terms of any other LCMs, is there any others in the pipeline?
Yes, we have a letter in which another submission to our minister on one for the Small Business Enterprise and Employment Bill, and that is to do with redundancy clawback, and it is with regards to people in the public sector who earn over £100,000 per year, and if they were made redundant and then took up another post in the public sector in a very short time scale, there would be provision to claw back all or some of the redundancy paid out at the time.
Is that the only one you're aware of?
Right.
Is that the only one?
That's the only one, although we received a letter yesterday actually on this particular LCM, and as I said, they have still been developing the policy, so we will have to address it. It has raised the issue of cash equivalent transfer values for funded schemes.
What's the time scale for the clawback LCM?
The clawback LCM, as I say, we've just written that, just submitted it yesterday, so that will be relatively soon because it's something that would like to be addressed by April 15 as well.
Okay, Leslie?
Yeah, thank Chair. Just there is reference in the paper that there's legal competence in amending the scheme, and therefore that's really the main driving in introducing the LCM. Could you maybe just develop that a bit more? What particular aspects of legal competence are there?
Is this in the executive paper?
Yes, I think it's the executive. Yep. It's the DFP paper.
Yeah, I think it's intended to highlight that the EFP would have an interest in the protection of the public funds associated with the unfunded schemes. Therefore, there will be legal competence in taking forward the LCM.
To protect, if you like, the lack of money.
We check the available funds for those unfunded schemes, and also to account for any impacts if people did decide to transfer out to the defined contribution schemes.
So if these were not simply funded out of revenue, to use an old-fashioned expression that I still understand very well, if in fact there had been some other investment fund, it wouldn't have been a problem. like the local government scheme, for example?
The policy intention is that the local government scheme would be allowed in circumstances to transfer. Members would be able to transfer out. The rationale being that because that fund exists, it's more feasible to liquidise the assets associated with it in the event that people, or a vast majority of people, decide to transfer out. But as Bernard pointed out, there are still some issues associated with that being considered to protect the scheme in the event that there would be a massive group decision to transfer out.
But there could, of course, be at any stage be an injection of money in to protect the scheme, the unfunded scheme anyhow.
It's a possibility, but I think, as Bernard also tried to point out, there's a cost mechanism associated with the schemes, and that could be affected by any significant draw on the available funds, which could mean that those members who decide or choose to stay in the scheme could be faced with higher contributions or amendments to the benefits that they might have.
Picking up the deficit, yeah.
Okay, members? All right, Stephen, Bernard, thank you both again.
Right.
Moving on, members, to current accounts. A couple of grievances, sorry, first. Can I seek agreement to write to relevant trade unions for an urgent response on the provisions as outlined in the LCM grade? Yep. And seek agreement to notify other applicable Assembly committees of today's evidence in the meantime. Agreed? Agreed. Moving on, current account switch service, briefing from the Payments Council. Can refer members to pages 29 through to 46 of your packs. And can I welcome Tim Yudden, Director of Collaboration and Change of the Payments Council, to the committee. Mr Yudden, would you like to make an opening statement, and then we'll move to questions.
Good morning. Thank you. I'm very pleased to be able to come and speak to you this morning about the current account switch service. It's a very young service. It's been going for about a year now in the UK, or just over a year. And it is a world-class service, and I hope to give you as much information as you require from me today on the subject. I mentioned that it's a world-class service. It was also the first of its kind in the world, so there's no other place in the world in which consumers are able to be empowered to be able to switch their bank account from one institution to another in 7 working days, with all of the protections and the guarantee that the service offers. The service was researched quite extensively before we launched it. In Northern Ireland, we came to Belfast and Ballygowan to speak to consumers locally to understand what it was that they wanted from the service, as well as across the rest of the UK. And we designed a service that we believe is operating very, very successfully. It's very much designed to enable people to move from one institution to another. What we need to be really clear about is that consumers, small businesses and charities that can avail themselves of the service make that choice for themselves. So they make a decision about whether they wish to move from one institution to another based on reasons such as service or product offering, etc. What the service does for them, the current account switch service does, is enables that switch to take place in a very quick, swift, easy and hassle-free way. We designed a guarantee which is offered to the new service to the consumer rather by the new bank, and it promises customers that if anything goes wrong with a switch, the new bank is responsible. So the new bank is responsible for opening the new account for the customer, making sure that they initiate the switch, dealing with the old bank, moving all of the standing orders, direct debits, and everything that's associated with the old bank in terms of the current account payments to the new bank, and then closing the old current account at the old bank for them. In addition to that, there's an insurance policy in place just in case somebody should decide to send some money to the old bank account that is caught and redirected on the same day and is sent to the new bank. So as far as consumers are concerned, there's absolutely no loss of service. So what that means is if a consumer, for whatever reason, wants to switch bank account, they can go from one to another and they never have to deal with the old bank again, because the new bank will take care of all of that for them. So that's just a quick outline and introduction to the service. Just to give you an example of how well that works, in the first few weeks of the service, one of my colleagues switched bank account, and she was told that 11 o'clock on the switch day her account would be available in the new bank. Up to that point in time she was with the old bank, so she had no loss of service. At 11:03 she went on to her online banking, she opened up her new bank account, and all of her direct debits and standing orders were there, including the names of people that she used to send money to for Christmas, etc., including all the nicknames that she gave to them as well. So it's a really very comprehensive service that she was given. Once somebody has switched, that means that a redirection service can operate. So that safety net I've talked about earlier, or that insurance policy, is in place, and it makes sure that if for any reason somebody's trying to send money to the old account, not only are they advised, but as far as the consumer is concerned, that money is switched on the same day to the new bank account. So again, no loss of service. It's very different to switching that takes place in other areas of the market. So, for example, I have a personal experience. Earlier this year, I moved my mobile phone contract twice, once for corporate reasons and once for personal reasons. The corporate move, I was out of service for 7.5 hours. On a personal basis, I was out of service for 9 hours. But if I switch my bank account, I have no loss of service at all. So I think that's a really good example of how well we've designed the service and how well we believe that it operates. It is early days. It's been going for just over a year now. It was designed to assist consumers to make their choices if they wish to move banks from one place to another. It's very much that choice is for consumers. It's in the competitive space. It's up to the providers to offer different levels of service or different products in terms of the current account market. The service enables that to happen. And though it's not a prime driver of the service, switching volumes have increased by over 22% in the first year of service, which I think is a reflection of the confidence and the awareness that consumers have in that service. So that's a quick sort of canter through introduction. I know there's some information that we've provided to you already, and I'm very welcome to take any questions.
Thank you very much, Mr. Yoden. In terms of customer awareness, and I see there's reference to this in your presentation, that awareness is currently pegged around 69%. What is your sense of what the awareness is of this locally? And how much awareness is it? I mean, it says here that the question asks is, have you heard the current account switch service? I mean, I think most of us here have heard of the current account switch service, but in terms of the detail of it, I'm not so sure there's that much awareness of it. I think the more people know what the process is to change the current account, the more likely they are to avail of it.
I entirely agree with you. I think when you launch a new service like this, it's a bit like a snowball. It'll gather as it sort of rolls down the mountain. As we increase the awareness of it more generally, but also as more people start to use the service, they'll talk to their friends, family, maybe business colleagues, etc. So that will increase. My expectation is that you're not going to get to 100% awareness of it in a very short period of time, but we do have targets around that, so we're on track to achieve our target overall of 75% awareness of new service by middle of next year, which is a target that we set with the Treasury when we initiated the service.
The Consumer Council informed the committee that over 5,500 people have switched their bank accounts since this was introduced. Is there any possibility that we could get a breakdown of this figure in terms of how people have moved to and from, in particular the big four banks here, Danske, Ulster Bank, Bank of Ireland and First Trust?
So we do publish figures on the Payments Council website in terms of what we call the winners and losers, who's taking market share and who's losing market share. For competitive reasons, that data is published with 6 months in arrears, so the latest figures are on after the first quarter of 2014. If you wanted to know more about individual institutions' activities, unfortunately you're going to have to go to those individual institutions, because for privacy point of view, we don't actually see individual switching, we just see it at an institutional level.
And what sort of engagement has there been between the big four banks here and yourselves in the Payments Council?
So in terms of the engagement, they were very heavily involved in terms of designing the service initially, and also now the service is operated by BACS on behalf of the Payments Council, and we have the chair of the management committee of CAS is actually a senior manager from Northern Trust Bank here in Northern Ireland, and obviously he's in a very good position to raise awareness of the service in terms of the Northern Ireland perspective.
Paul?
Thank you very much. I appreciate that we're dealing with a culture of people who, for one generation or after another, seem to be quite loyal to their local banks, and the switching culture probably was highlighted greater in relation to Northern Ireland as a consequence of an IT glitch that occurred within the RBS system as well as the interbank system in Northern Ireland, and took quite some time to resolve. As a consequence, a lot of people went down the route of wanting to switch bank at that stage, and appreciate that it says within your book that there was, or within the report, that there was 89% satisfaction with the process. Well, that indicates that there was a percentage, 11%, that it didn't go right for on occasions where maybe something didn't go right, go just according to plan. What mechanisms in place to ensure that we don't have IT difficulties between one system and another, and the guarantees of payments not being received on time, or some customer receives penalties because it doesn't necessarily happen? I appreciate you give an example of 3 minutes past 11 and making an issue 3 minutes past 11. Well, that might well be on the 89% of cases, but there's 11% where maybe it doesn't happen. And what protection is there for those people who incur additional costs associated with some mix-up that has happened along the way? And what institution takes up paying back that compensation?
Right, okay, I think there are probably 4 parts to your question. If I can deal with the first one, unfortunately I can't comment about individual IT within institutions. That's something that you need to address to them. In terms of operational procedures within the service, because of the way the service is designed, the process takes over 7 days, but the switch actually takes place on that 7th working day, which is a date of the customer's choosing. So nothing happens until that point in time. So there is an opportunity, if something is going wrong, to pick that up and make sure that the customer either stays completely in the old bank or is moved entirely to the new bank. You're not in a situation where you're halfway in between. I think your third point was around who is it that is responsible for that. Once you initiate a switch, it is entirely up to the new bank. It doesn't really matter whether there's a problem being that there's the old bank. It is a new bank that provides that guarantee to the customer, and it is the new bank that actually is responsible for making sure that things don't go awry. And last but not least, it is also the new bank that is responsible for making sure that if for any reason the customer is out of pocket, that issue is resolved, even if it was with the old bank. So it's the new bank that talks to the old bank, sorts that out, and the consumer is not affected by that. I hope I've answered your questions.
Well, it does, but there are a number of people who have this idea that if I switch bank, I'm closing down one account and opening another. But there are a lot of people who have this fear, and I receive a payment once a year and it goes into that bank account, and I'm going to just keep that wee account open. If they do not close down the account that they're transferring from, do they fall outside the protection?
They do, because consumers have a choice. Some consumers work on the basis of they like to try before they buy, so they might open a new account within a new institution, try that for 3-6 months or whatever, then decide to switch. At that point, if they choose the full switch, then they can switch everything from the old bank to the new bank. Just to your point around if something comes in after a year, there is a 13-month redirection service, which we just made a decision about extending that to 24 months, just to make sure, absolutely sure, that if somebody inadvertently tries to send money to the old bank account, it is redirected, as I said earlier, on the same day to the new bank. And most importantly, the originator making that payment is advised that this is now the new bank, so they can amend their records and send it to the new bank.
And finally, I appreciate, finally, has one of the reasons for bringing forward a process where it is a straightforward, seamless transfer process was to get value for money and to ensure that competition has given value to money to the end user. Has there been any work done to identify, is that a reality, or is a cartel still working within the banking system?
So I can't comment specifically on institutions, but what I can say to you, and I'm sure you can seek it out and see for yourself. Since we've launched the current account switching service, there are a number of banks that have upped their game in terms of providing better service to their customers, because it's very, very easy for a customer to switch away. The way the service works is that if you're the old bank and you're sitting there, all of a sudden you get an electronic message to say your customer wants to move, and you cannot avoid that move. You cannot stop it. So that's very, very powerful, and that incentivises banks to provide a better service. In terms of the direct point around perhaps the economics, it was where your question was headed. There has been a notable increase in new products being offered by banks, both the challenger banks, as they're known as, but also some of the existing institutions. So it's quite interesting to see that there are a lot of current accounts now that pay more interest, for example, than some of the savings accounts. And that's all, in my view, that is part of the change in the marketplace where institutions are seeking to up their game to make sure that customers don't leave them, but also they're putting into place both service incentives and product incentives, including interest rates, etc., to incentivise customers to move. So if I take that evidence, I think that's good evidence of the market operating competitively. But ultimately, it is down to consumers to make those decisions. And I think, as you said, there are some consumers who are very happy with their bank for whatever reason, and actually, switching bank accounts is not on their radar. But there are others who choose to become informed and look for different institutions, and then we have a switch service that can enable that to happen in a very simple way.
Thank you. Okay. Deputy Chair. Thanks, sir. Good morning.
Good morning.
Paul mentioned there the fact that obviously some people may have switched within Northern Ireland here because of the IT difficulties that some of the banks had. Do you conduct any surveys to ascertain the reasons why people switch?
Yes, we do. Fundamentally, there are three major reasons. It's either because the new bank is perceived to offer a better service than the old bank, or it's because somebody's been essentially pushed away from the old bank due to poor service. And the third reason, which is still quite an important reason, is location. So people tend to move jobs, move house, and people like the comfort of a local physical branch. That's still an important driver. Having said that, over time that will potentially slowly diminish with the younger generation who's more used to telephone banking, mobile banking, internet banking, etc. So I expect that to move over time. But those are the three major reasons. The two ones are service, either pushes you away or pulls you into a new institution.
Right. Well, those are pretty general reasons. You have nothing more specific than that?
I'm not sure where your question is leading in terms of more specifics.
Well, in terms of benefits and so on that one bank offers over another?
Well, I think that's one of the things that is very much in terms of consumers. It's their choice. So if they believe that they're going to get a better service from a new bank, they will go there. If they are very unhappy with their old bank, and that is a reason, unfortunately. That is one of the push reasons why people leave. Location as well, but there are also other aspects, of course, which don't seem to be that important, but may grow to be important around interest rates on the product itself, features of the product itself. There are a number of banks that offer very simple current accounts. There are also banks that offer package accounts that come with a range of services, some for a small fee, and consumers might look at that and feel that that's a good reason to move because they feel overall they're going to get a better service experience and get a better product from a new provider.
Since when you initially came into existence, was there a sort of surge to change, and has it levelled off?
It's potentially not been a surge because it's a brand new service, and obviously people need to get used to it. But there has been a 22% increase in switching in the first year, and one of the things that I found really, really interesting was that on Christmas Eve of last year and on New Year's Eve of last year, on both of those dates, there were over 3,000 switches actually happened on those dates. Now, if you think about it, if we go back to the old service before we had CAS, how many consumers would trust for an institution to get their switch right on the day before their Christmas and still have their bank account open and money in there and their salary going in and their mortgage going out? And yet, That's now happened. I was quite surprised with
There's
those
quite a few
figures.
when they look at their overdrafts, it feel like switching. Run away from it.
Christmas?
Yeah. The chair mentioned there, you know, that he referred to the awareness in general and locally here. What are you doing to increase awareness?
So when we launched the service initially, we had a national consumer campaign. It was the Account Switch service was on television, and since then we've looked at various different ways to increase the service. So one of the things that we're looking at the moment is trying to increase awareness of the service around the small business community as well. So we do some work with some of the trade press and some of the Small Business Federation, etc. So we do that kind of work. But one of the key features of the service is that there is a trust mark, the Current Account Switch Guarantee, in black and white, and I'm sure that if you go down the high street, you'll walk past certain institutions and you'll see that trust mark is in the window of many banking branches. And it's a bit like in the travel industry, there's a protection provided by ABTA and ATOL. That's the concept behind the guarantee, and a lot of of the institutions are using that guarantee to promote awareness of the service over and above any activity that we might do in the centre. And it's one of those things that I think will build over time. Awareness will build over time, and then obviously usage of the service will build confidence, and then word of mouth will build that confidence as well.
Okay, thank you. Thanks, Chair.
Just a couple of questions. Is there any statistics for refusals by a bank to take a person's account?
Are you talking about opening an account?
No, say like you go for a switch guarantee. Is it the our bank has to take the person who's making the request?
I'm not sure I understand the question, but if you
I
open
want
your
to switch
account,
account,
yes.
Has the other institution the right to say no, we don't want you?
No, they have no right to do so. So then if you as a consumer want to go to a new bank, you open your account with a new bank, you're happy with your new bank, and you ask your old bank, your new bank to switch you from the old bank cannot stop that switch. The
new bank?
The new bank can asks the old bank to.
But I think the point being that basically can a new bank refuse to take you as a customer?
All right, so that's part of the account opening process.
Yeah.
That obviously that's a decision for you as a consumer. That's a decision for that institution in terms of know your customer and anti-money laundering, all those other kinds of things.
Sorry
That's the
for
account
my-
opening
No,
process.
that's sorry, not a personal example.
But is there statistics for the refusal? So, we know that so many people have done this successfully. Is there numbers where people have been unsuccessful?
As in opening an account, those are not things that I would be aware of.
Okay.
You'd have to speak to individual institutions about that.
Because it's interesting in terms of the switch guarantee, Trustmark. I went on to two websites, the Bank of Ireland and the Allied Irish Bank. And it's not very obvious in their opening pages that they have this.
Okay, right. Well, that's perhaps something I might raise with them.
Yeah, now, maybe they are, but it's not obvious, right? So again, I want to say that, right? And does the banks like this idea, or is the banks cold to the idea that people can switch? And
So that's very, very much a question you probably have to address to the individual institutions. The ones that I speak to, particularly the challenger banks, very much welcome the service because they find it a really quick, easy and hassle-free way for moving consumers from the old bank to the new bank. And if you're a new bank and you enter into, if I'm the new bank and I enter into a relationship with you, the first thing I want to do is make sure that the early weeks and months and hopefully many years of your experience as a customer of mine is a really good one. So having a switching service that is really seamless really, really helps that. And that's the feedback that I'm getting from those banks.
yeah. But the point was made, and I think correctly, is that people are very conservative when it comes to banking. They start a bank, so the banks maybe just say this is a bit of a nuisance at times.
Again, I suppose that's a question you need to ask them. But if you think about it from a new bank point of view, it's a really quick and seamless service. And if you're an old bank and you're unfortunate enough to lose a customer, at least the process is relatively easy. Yeah. And what you don't have is what you had a year and a half ago, where potentially you'd have a situation where the salary is going to the old bank, the mortgage is coming out of the new bank, and never the twain shall meet. So we've resolved all of those issues in terms of really smooth and seamless switch on one day.
And I mean, just out of ignorance, the current account switch, what about a savings account? Does that go as well?
No, the Independent Commission on Banking requested us to put into place a current account switching service, and the reason for that is because many people see that as their central account with an institution and tend to have savings accounts and other types of accounts, possibly the same institution or elsewhere. But it was perceived that one of the barriers to switching institution from one place to another was the centrality of that current account, hence the service is about the current account.
Okay, thank you.
Adrian?
Thanks, Chair. I was going to ask the same question as Raymond there about the banks refusing anybody, but you've sort of answered that there. Have you any data just relating especially to Northern Ireland? You know, data's all put together here for the UK.
Yes, unfortunately, I don't have that. I think the point I raised earlier, we see at macro level switching at an institutional level. It's also to do with the way that sort codes operate, but we don't see individual data, obviously, for
But
data
surely by
protection.
the sort codes, that'd be enough to gather the data for Northern Ireland.
Yes, so we do publish if you want, the winners and losers in terms of who's gaining and who's losing current account, and obviously you can look at that on our website and see, you know, pick out the Northern Ireland banks. What you won't be able to see is the fact that there are other organisations who have moved into the market in Northern Ireland, but the representation, the figures are very much on a national level. Yeah. Unfortunately, I don't have those numbers.
And there's no intention to split them over to show us that?
That is something I think that we could consider, but it's a very young service and there's quite a lot of demands in terms of
I think it's a great service. And
yeah,
I know people who have used it and nothing but praise for it and how simple it was.
Thank you.
But no, I'd just like to see the figures for here, just to weigh them up in my own head, you know. But thanks, Chair.
Paul?
Just finally, nationally, I appreciate that this is a national system which is operating, but banking being sort of international now, and many people having links to banks that are maybe not necessarily based in the United Kingdom. Has this model that we're using here, has it been looked at by other jurisdictions with a view to implementing it? I appreciate we're the forerunners here.
Yeah, we are the forerunners, and since we launched the service, we've had a number of banking organisations from different countries have either been visiting the Payments Council in the UK or conference calls, really quite interested in the service, and I won't remember them all, but Nigeria was one, South Africa was another. There's some in Europe. Yes, some very
banking system. I would be only looking for a back door and to create some fraud on it.
But there has, to answer your question, there has been a lot of interest in other parts of the world, and it's not just the system per se, but it's the fundamental concept of giving that customer guarantee, which is quite unique. So there are other places in the world where you can switch bank account, but it's very much done on how well the old bank does it, how well the new bank does it, but there is no sort of guarantee in place.
Thank you. One of the stated aims of the scheme is to increase competition and choice in the high street. But I was looking at the Which survey, and it shows that many of the top rated banks still don't have a presence here locally. Is that something that you see changing anytime soon as a result of the scheme being rolled out?
So that's one of those questions, unfortunately, it's in the competitive space. You'd have to address individual institutions in terms of what their footprint is in here locally. But I think one of the challenges that all banking organisations have is responding to customer needs and consumer behaviour, and certainly I see in my children and the younger generation, a very active move towards mobile banking and internet banking and telephone banking. So for a lot of them, physical branch presence isn't important, and I suspect over the generations that will change banking quite substantially. Having said that, I respect the fact that there's an older generation, including my mother, who likes to be able to walk to her local banking branch and using that. So I think we will see changes in banking over the next few years. How that pans out, I don't know, but ultimately whether or not to have local presence is going to be one of those things based on consumer demand and individual institution choice about where they wish to have their footprint.
And do you think that the local banks, the big four, as was referred to earlier, are responding to the risk of more consumers looking elsewhere? because at a fleeting glance, there's not that many incentives that they're offering compared to many of these other banks. So are they still assuming that most people here locally are just going to stay where they're at?
Again, I suppose that's a question that you'd have to address to them individually, but I suspect if I was one of those banks and I was losing a lot of customers, I'd be doing something about it if I haven't done something about it already.
Okay. Okay, members?
Yeah.
All right, Tim. Thank you very much.
Thank you.
Okay, members, given the cross-committee relevance of the briefing paper, can I seek agreement to copy the paper to the ETI Committee for information?
Yep.
Okay. Okay, can I advise members of previously scheduled oral briefing from the Consumer Council on this matter had to be deferred to make room for the DFP session on the draft budget 2015-16. This is in relation to financial institutions and impacts on consumers. I can refer members to the briefing paper pages 48 through to 57.
Yeah, Chair, just the paper outlines some kind of current issues within the local banking sector, including the issue of financial capability, competition, the impact of bank closures, the issue of consumer confidence, including the need for secure IT systems, as well as the ongoing issue of the non-publication of the FCA's investigation into Ulster Bank IT glitch in 2012. We've just been checking in the last few days with the Westminster Northern Ireland Affairs Committee, Chair, to see what the timeline is for the report from its inquiry into the banking sector in Northern Ireland, which this committee gave evidence to in conjunction with the ETI committee last Christmas. So we're being informed it's likely to be coming out in the next few weeks, and there may be scope for this committee to consider follow-up issues arising from that report. Also, in addition, the Consumer Council has informed us that it's actively researching the impact of all of these issues in relation to consumer confidence and trust in banks locally here, as well as the procedures that banks are employing when closing branches. So, Chair, the work programme permitting, members may wish to receive an oral briefing from the Consumer Council early in the new year, when both the latest research has been published by the Council and also when the Westminster inquiry report has been published. Chair.
Okay, members. Can I also suggest as well, in terms of the it might be an idea to propose that they come to the committee once they finish and conclude their findings in terms of IT and in particular branch closures as well, which is particularly relevant in terms of rural communities. Are members content with that?
Yeah.
Moving on then, moving on to correspondence then, members.
Chair, just as we await the witnesses, we're running a bit early for the next session. I'll just deal with correspondence. Just draw to members' attention the items of correspondence requiring decisions. Most of the correspondence is for noting, but there is a piece of correspondence at page 118 of the packs. It's from the ETI committee. It's a memo regarding a visit that the committee had undertaken to SDC coaches in near Toonbridge there, and they had raised concerns around the outcome of the non-domestic revaluation, and so the ETI committee is writing to this committee about that issue, and so it's just really to seek members' views if they're content to forward the correspondence to the department, just reiterating that this committee has previously stressed the need for effective communication in terms of the expectations around the outcome of the non-domestic revaluation, and also to write to the ETI committee explaining that this committee has done so and will continue to reinforce that message.
Okay, agreed.
Then finally, there's an assembly research paper at page 134 of the pack. And that relates to the Barnett, to the the review of the Barnett formula that the committee is undertaking. And it just provides a recap on relates to some of the previous papers that have been produced, but also provides an update on some issues subsequent to those papers being published, and has identified some issues for consideration by the expert witnesses that are scheduled to come to the committee over the coming weeks. Chair. Next week there's one, possibly two, of the previous expert witnesses coming to the committee to provide an update briefing, Professor Alan Trench and Gerald Holton. So it's really just to seek committee agreement to forward the research paper on to the witnesses, just to inform their evidence to the committee.
Agreed. Okay, members, whilst we're waiting for witnesses, just to move on to any other business. Can advise members of the debate on the committee's inquiry into flexible working is scheduled for Monday the 10th of November, and formal printed copies were given to members on Monday past. There's a draft press release at pages 97 through to 98.
Just in terms of formal, I don't remember getting one on Monday.
The inquiry.
Yeah,
was sent
it
to
would have been pigeonholed, Chair, on Monday. So we'll double check and we'll get copies around.
There's extra ones here anyway.
Well, there's actually one, yeah, I mean, sure. There's a few
I
extra
can
ones.
email copy of it. Could I?
What's that?
Could you email me a copy of it?
Where? Physical.
Got it.
Thank you. Thank you, Paul. Didn't get it.
Email those up as well.
Okay, I can refer members to draft press release at pages 97 to 98, which, subject to committee agreement, will be issued to coincide with Monday's debate. Can I seek agreement that pre-release copies of the embargoed report are issued to selected media outlets in advance of the debate with the agreed press release?
Excellent.
Agreed? Can I also advise members that information on members' attendance at committee meetings during the 2013-14 session has now been checked and verified, and the relevant information will be placed on the committee website on Friday the 7th of November. And then the committee work programme is at pages 152 to 155. Members content to proceed on that basis? Agreed. Okay, members, moving on to the outcome of the October monitoring round. There's a copy of the Minister's written statement on this, page 59 of your pack. And can I welcome to the meeting Joanne McBurney from Central Expenditure Division and Stephen Barrett from CED as well. Do you want to make an opening statement just on the monitoring round, and then we'll go to questions?
Okay, thank you, Chair. Thank you for this opportunity to brief the committee on the outcome of the 2014-15 October monitoring round, as detailed in the Minister's written statement to the Assembly of 28th of October. As you'll recall, the main non-ring-fenced resource DEL elements of October monitoring were outlined in the Minister's statement to the Assembly on the 13th of October. As a consequence, the Executive did not consider any further non-ring-fenced resource DEL bids as part of this round. Therefore, the written statement of the 28th focused on the Executive's capital DEL position. However, in addition, there were a number of movements relating to non-cash ring-fenced resource DEL and a number of technical issues relating to the non-ring-fenced resource DEL that were addressed. Turning first to capital DEL, the Executive entered the October monitoring round with an overcommitment of £38.6 million. Department surrendered capital reduced requirements of £69.3 million, which left the Executive with unallocated funding of £30.6 million as they went into this round. As a result, the Executive agreed capital DEL allocations totalling £43.5 million. That included £4.7 million to DECAL for City of Culture legacy projects and museums maintenance, £13.5 million to DSD for co-ownership housing, £19 million to DRD, which included £15 million for road structural maintenance, £1 million for bus and rail infrastructure and £3 million for local transport safety measures, was 2.3 million to DARD for CAP reform ICT costs and 4 million to health for medical equipment, ICT and health and safety measures. Following these allocations, the Executive exited the October monitoring round with an overcommitment on capital DEL of 12.8 billion. Returning to Resource DEL, as detailed in the Minister's statement of 13th of October, the Executive had an overcommitment on the non-ring fence Resource DEL of 25 million. A number of small technical adjustments now mean that the overcommitment carried forward into January monitoring has been reduced to 24.7 million. On the ring-fenced Resource DEL, there were a number of adjustments to departmental allocations, and following that, the Executive exited October monitoring overcommitted by 4.6 million. Sorry, a couple of other items to note. On delivering social change, the Executive also agreed that 1.5 million of Resource DEL funding set aside for the childcare strategy could be used for delivering social change projects this year. The Minister's statement detailed a number of allocations across departments, totalling 1.5 million. 12.9 million of capital DEL relating to Social Investment Fund was surrendered to the Centre as a reduced requirement. And in terms of financial transactions capital, the Executive exited the June monitoring round with unallocated ring-fence financial transactions funding of 30.2 million. In this round, DETI declared a reduced requirement of 5 million relating to the Agri-Food Loan Scheme. There were no bids received for FTC from departments. As a consequence, the Executive exited the October monitoring round with 35.2 million of ring-fence financial transactions capital unallocated. The Minister has highlighted the risk that some of this funding could be lost to Northern Ireland and has once again encouraged ministers to come forward with suitable proposals that can utilise this funding. Chair, I'm happy to take any questions the committee may have.
Thank you. In reference to the conditions attached to the 20 million that was allocated to health, namely that the Department demonstrates it's taken the necessary actions to ensure it remains within its budget control total. It was also pointed out that DFP officials have been working closely with their counterparts in health and have confirmed that DHSSPS have considered the position and are taking the necessary actions to address the budgetary pressures that they face this year. What specific actions are health taken in this regard, and have they provided the Department of Finance with the necessary assurance the health department's not going to breach that budget control total again?
DFP officials have been working very closely with their health counterparts over the intervening period between the June and October monitoring rounds, and health have produced a paper for us detailing the actions they would have to take forward to manage within those constraints. In addition, in a statement to the Assembly on the 30th of October, the Health Minister outlined a series of actions to be taken forward in the remainder of 14-15. Unfortunately, I don't have the detail here. Stephen may have some of those with us, but they do reflect what's achievable in maintaining patient safety and minimising costs between now and the end of the financial year. So as a result of the paper we received and the ongoing work, DFP officials are content that health are taking appropriate actions to try and live within their budget for this year.
And what is the Department's up-to-date assessment of the risk of FTC funding being handed back to Treasury at year-end, and why has there been such a reluctance from departments to avail of this?
It is a risk, and I think we're acknowledging that risk, that it is a concern that may have to be handed back to Treasury. In terms of the reluctance, I think FTC is a very new funding stream for departments, and it's them trying to get their head around it and identify projects that are suitable for it. Because it has to be used as a loan to or equity investment in private sector entities, that's a sort of step change in the way departments are used to funding projects, and it's just taking a bit of while to work that through and get suitable proposals on the table. There are, I think, a few proposals currently being considered, but I don't have the details of those yet. But it is, you're right to say it is a risk that may be lost this year.
Just on that point, I mean, I appreciate what you've said earlier, that in terms of the ministers is simply is encouraging, if you like, and trying to stimulate other departments to do this. And I appreciate bids have got to come through other departments. Is there any other way that the department could highlight this in a wider sense? And I wouldn't say cut out the other departments, but to some extent try to get the message, because part of this obviously will be essentially encouraging funding of private equity as part of sort of a partnership with the departments, but to maybe get more directly the message out to the private sector to say, look, here is something that's potentially there. You need to maybe be knocking on the door of government departments to say that. I'm just wondering how maybe more proactively could be pursued.
Yeah. The Strategic Investment Board is actually putting that message out there with the private sector to try and encourage that, and there are some projects coming forward. And of course, the development that the Minister announced of the Northern Ireland Investment Fund will also help utilise that funding once the feasibility study is complete.
Is it?
It's just on the same thing. I've been knocking on about this for about 2 years, that we need some sort of a recognised and viable process to deliver on this. Now, so far there isn't one, but what I want to ask you about, there is talk of this investment fund as a way of sort of, if you like, usefully mopping up any FTC that there is about. Is there any reason why all FTC couldn't go into that initially?
Well, obviously, we still have to have the feasibility study completed on that fund to determine the scope and scale of it. But no, off the top of my head, no, I don't see any reason why that couldn't be the case.
At least that way it'll be protected.
Yes.
Are there any other processes that are being thought about to how, in fact, it can be, utilised to the maximum?
There are a number of ongoing discussions with departments around specific projects, but I think the Northern Ireland Investment Fund is probably the most ideal one for finding a mechanism to get a lot of it out the door.
And when will we know whether that can be safely done, that all FTC goes into that fund initially and therefore is not lost?
Well, a feasibility study is being undertaken or is about to be commenced, and once that feasibility study is complete, then we can report back.
Include financial competence and that it doesn't breach any legal?
Yes, that will all be considered as part of that.
Okay, thanks.
In terms of the reduced requirements, there's a significant amount of money going back from DRD. All road projects, A2, A26 and A8, totaling some 13 to 14 million, I think. Is there concern about the level of money being surrendered there in terms of capital?
I think it's inevitable with capital projects that there will be an element of slippage, and so that is quite expected. I'm turning to Stephen, he probably has some more detail on the specifics of the DRD projects.
Yes, I mean, there has been some slippage across some of the schemes detailed in the tables. However, some of the reduced requirements do relate to additional EU funding being captured by the department, and obviously in line with the monitoring rules, they have to surrender that to the centre. But you are right that there has been slippage across a number of the schemes detailed.
Also, in terms of the overcommitment, 12.8 million in capital and 24.7 million on resource. How prudent is that level of overcommitment at this stage of the financial year, especially given the financial environment we're currently in as well?
Well, turning first to probably the easier of the two, the capital, I think 12.8 million is very prudent or is reasonably prudent for this time of year, because we do expect an element of slippage in the capital project, so I don't see that being an issue. The 24.7 million in the resource, of course, you've correctly said that it's a very difficult financial position this year. However, we would still expect there to be a number of reduced requirements coming later in the year and around January monitoring, and we're relatively content that that will be able to be managed downwards.
Okay. Members, any other questions?
Thanks, Chair. There's a lot of concern now about ring-fence money. Up until this point, it really was taboo to look at them at all or to review them. But now we're seeing ring-fence money's been released. Is it not time to bring in a proper review of ring-fence monies as well?
Have you any specific details on which ring-fence monies are being released?
Well, there is reference in the monitoring round here to one, but I'm more concerned with the general picture because it applies in resource and indeed in capital. And there's a lot of talk now, in the business world about this. Ring-fence monies were always locked up and that was it. They need to be reviewed. Do you subscribe to that view, and are there any plans to do just that?
I'm not aware of any plans to do a review of ring-fence funds as such. Obviously, when they are ring-fenced, a view is taken over what that money is to be used for and that it should only be used for those purposes. But I wouldn't disagree that it's a useful thing to do on an ongoing basis, is to review any decisions to ensure that we're getting the best value for money and utilising resources in the best way.
Because there are examples where they're kicked along year on year and in fact doesn't happen, so I think I would welcome that as a positive move forward.
Yeah, that's certainly something we can consider.
Okay, members. Okay, we'll move on to the next session. So, thank you, Stephen.
Thank you.
You're free to go. Just before we move on in relation to the Minister's concern regarding the Department's uptake of FTC, can I seek agreement with members of the committee rights to other committees? They ask that they press their departments to fully explore this form of capital investment urgently.
Yes.
Agreed. Moving on to the draft budget then. A reminder to members the research paper outlining some potential issues is at pages 3 to 13. And also there's papers from pages 14 to 94 of your table papers, and a copy of the report by BBC on the budget, page 73 of your more substantial pack, and a timeline comparing 2011-15 and 2015-16 at page 95. Jeff McGuinness, isn't?
If you want to go ahead, you might get all the detail from me. I won't attempt it.
Do you want to make an opening statement on this one, Joanne?
Yeah, if you want me to, and that will be delayed long enough for Jeff to get here.
Any tough questions?
Unfortunately, I talk quite quickly, but probably none of what I'm going to say in the opening statement will come as any surprise to anybody, but I'll go over it again anyway. I think the most important message coming from the Minister's statement on Monday is that the pressures facing the Executive in 15-16 are not going to be limited to 15-16, with the OBR forecasting that at a UK level Resourcedale will decrease by a further 13% in real terms by 18-19. The Executive is going to be continuing to face downward pressures on their Resourcedale, and it's important that the decisions we make now enable us to live within those constrained budgets going forward. In terms of the overall budget position, for 15-16, the total Resourcedale is 10.2 billion. Of that, some 550 million relates to ring-fenced Resourcedale used to fund non-cash costs such as depreciation, repair and impairments, which leaves 9.7 billion non-ring-fenced Resourcedale to be used to fund ongoing public services. That's a 1.6 real terms reduction on the 14-15 position. Total capital Dale budget is 1.1 billion. That's up 41.2 million since 14-15, which in real terms is a 2.2% increase. However, that includes an increasing level of financial transactions capital, some 128 million, which may only be used for loans to or equity investment in private sector entities. In terms of key executive decisions taken in the draft budget, 100 million of capital Dale will be held centrally to repay the 14-15 reserve claim, and HM Treasury have been approached to ask for flexibility to repay that from capital as opposed to Resourcedale. Treasury have also been asked to approve the use of 100 million RRI borrowing in 15-16 to capitalise the cost of a voluntary exit scheme, and funding is being held centrally in anticipation of this. 133.2 million Resourcedale is being held centrally to help alleviate departmental pressures arising from the revaluation of public sector pension schemes. And 70 million Resourcedale has been set aside to fund a package of measures designed to mitigate the impact of welfare reform changes. A feasibility study is being commissioned to inform the creation of the Northern Ireland Investment Fund, and that will inform the scope, scale, design and investment strategy of the fund. 12.5 million of FTC has been set aside to provide an initial balance, but that will not be the limit of the funding going into that fund. 30 million change fund has been established to fund cross-cutting reform initiatives and preventative measures that are expected to generate savings in the longer term. Regional rate will only be increased by the rate of inflation, and there is an anticipated 50 million of capital receipts to be generated by the asset management unit. In terms of central funds, 14 million Resourcedale and 15 million capital Dale for the Executive's Delivering Social Change agenda are being provided under the Social Investment Fund and Childcare Strategy. And EU match funding is being maintained at previous levels of 10.7 million Resourcedale and 8 million capital Dale. In terms of departmental ring fencing, the DOJ ring fence has been removed. Protection for health this time was limited to frontline health and social care elements, and the reductions that applied to other departments were applied to those elements of health that were not considered to be frontline health or social care. There have been no reductions applied to the Northern Ireland Assembly Commission, the Northern Ireland Audit Office and the Assembly Ombudsman Commissioner of Complaints, but they are expected to manage their pressures internally and to strive to achieve similar levels of savings which they could then surrender. Departmental Resourcedale budgets were developed on an incremental approach, so basically a roll forward of the 14-15 opening position, which was then adjusted to remove time-bound executive allocations and EU funding, which is yet to be allocated. The level of reductions was then agreed, which would provide funding for central strategic pressures, along with an amount to be allocated in support of key public services. The reductions totalled 872 million, or 15.1% of departmental baselines. Of this, 659 million was allocated back to departments. 534.5 million was allocated back for specific pressures, and those allocations were detailed in the Minister's statement, so I'll not list them all here. The remaining 124.5 million was allocated on a pro rata basis to those departments who were facing reductions to help alleviate some of the pressure. different approach was adopted for capital DEL budgets, where it was a zero-based approach and was based on an assessment of contractual and executive commitments alongside a consideration of PFG targets and departmental priorities. As ministers will have their own priorities, the capital position, while founded on specific projects and programmes, is provided as a capital envelope for ministers to allocate as they see fit. And in terms of public consultation, the public consultation period is to end on the 29th of December, and we're hoping an executive paper will be tabled on the 8th of January for consideration of the final budget position. I'm happy to take any questions.
In terms of pension reform and revaluation, the executives agreed to hold 133 million centrally to alleviate pressures arising from pension scheme revaluations due to significant additional employer contribution costs. Was that unexpected?
Not entirely unexpected. It's part of the ongoing pension reforms and revaluation that's happening at a UK-wide level. So there has been ongoing work on this, and the pension side of DFP are in very close consultation with Treasury colleagues and the Government Actuaries Division to try and manage that cost downwards as much as possible. It is going to have the biggest impact on the health and education sectors, and that's why I think it's important that we hold some funding aside, and we're hoping that we'll have final figures around the time of the final budget to be able to factor that in and allocate the funding out to departments.
Will the 133 be enough to cover this?
The latest
given that the revaluations haven't concluded?
The figures have varied over the preceding few months, weeks. At one point in time, I think it was 223 million. Latest information I have is that the 133 will be enough to cover it.
Will this be recurrent?
It will be recurrent, yes, because of the employers' contributions will increase going forward.
Could you give us some more detail on where this
Pension's
came from?
not my area of expertise, but each pension fund, although they're paid annually out of AMI, there is sort of a notional fund. In the same way that a private entity would have a fund to cover their pension costs, and they would invest that, there's a notional fund, and Jeff's going to correct me if I get this badly wrong, there is a notional fund set aside which covers the pension costs arising for your current employees. Every so often there's a valuation of that done to see if that fund is sufficient to cover the ongoing pension liabilities that you've built up from your current employees. This valuation has determined that that fund is not big enough, and the way that that's addressed, in the same way it would be addressed in the private sector, is that you increase the employer's contributions to top up that fund to the level required. So this is purely as a result of revaluing that fund and saying the funding set aside is not enough, and therefore we need to increase our employer's contributions.
Paragraph 5.2 of the draft budget states that ministers will seek to publish more detailed breakdowns of the proposed expenditure on the departmental websites. Has the department received any assurance regarding when that information will be published and available to committees to undertake the necessary scrutiny?
No, we haven't made a specific requirement on departments. It is just our hope that ministers will do that, and that departments will want to do that and engage. So we don't have a specific time scale, but I would imagine each department's own committee will want to, address that issue with them.
And given the potential for delays and engagement between departments and their committees, what is the absolute deadline that has been suggested for this committee's coordinated report?
Well, as I mentioned in my sort of overview at the start, the plan is to get a paper to the executive for the 8th of January meeting, which would mean we would obviously prefer to have this committee's report as far in advance of that as possible, because we want to give the proper consideration it needs. Ideally, it would be around the time that the public consultation ends on the 29th of December, but we will try and be as flexible as possible on that to work with you, but obviously we need to get it in advance of that executive meeting.
Mm-hmm. Pardon ignorance, but why is there that pressure? I mean, we're looking at the previous budget paper for 2011-15, and in that process, it was almost a month ahead, or a month behind where we're at now. So why the additional pressure here?
I think there's a number of factors. The first one being that the timescales in the previous budget process were not ideal. It meant departments didn't have a final budget agreed to March, which is very, very late when you're planning for a financial year starting on the 1st of April. In addition, this time round, the financial position is much more constrained. Last time, the resource DEL position was very benign. I think it was a 0.1% increase. This time round, departments are facing 10-11% reductions. That will need more time for departments to have certainty over what their budget is to allow them to plan. And so to allow them to do that effectively, we really need to have a final budget in place in January. which is why it's been constrained to 8 weeks consultation.
Deputy Chair.
Thanks very much. Morning.
Good morning.
Going back to the pension reform and revaluation, is that 133 million an estimate?
At this moment, it is an estimate, but it's based on the work that our pensions branch are doing.
Right. No pun intended. Is it a conservative or liberal estimate?
I think it's a realistic estimate based on the information we have.
No
to
parties
date.
involved in it at all.
I don't think it gives much scope either way. I'm hopeful at the moment that there won't be another pressure emerging out of that, but at the same time, I don't think it's over-ambitious, and I don't think there'll be a lot of funding to spare out of it. Of course, I hopefully may be proved wrong in one way, not the other.
Right. There mightn't be much to spare, but hopefully it's not a conservative estimate and we don't have to pay more.
No, hopefully not, and I think based on the recent information we have received from our pension side of the house, it should be enough to cover the pressures.
Okay. And can I ask you about the 100 million loan?
Yeah.
The Minister says that he's going to use capital receipts to repay that. Has permission been secured from the Treasury to do that?
Our Minister has been engaging with the Chief Secretary of the Treasury and has written to him formally. We haven't got a response on that, but I think we're hopeful that we will get that response, but obviously until we have something definitive.
So that's sort of a question mark over that at the moment?
I wouldn't go as far as saying a question mark. He hasn't been engaging, and I don't think we'd have built it in if there was an extreme level of uncertainty, but of course until you get something in black and white you can't say definitively that it has been approved.
Going back to that word conservative again, the Minister seems to think that 100 million in capital receipts is a conservative estimate. What is the maximum that we could hope to generate through capital receipts?
I'm afraid I don't have a figure with me for what we've generated in previous years. I mean, the 100 million is already built into departmental baselines. There's 108.8 million already in departmental baselines, so that level of receipts is definite. Those will be generated. On top of that, we've anticipated 50 million from the asset management unit. Obviously, those are slightly less certain, but we're hopeful that that is also a reasonably conservative estimate, and that should be.
So that's a total of around 100.
Just over 160 million in total.
150 plus.
Plus 109.
Right.
That are already there. The 109 are pretty certain. They're in departmental baselines and they have been identified.
And you're saying a further 50?
A further 50 has been anticipated through the work of the Asset Management Unit. We haven't built in any receipts based on the work that the Asset Management Unit has been doing with departments into departmental baselines. We've set 50 aside in anticipation that they will generate that amount.
Okay. Good.
Adrian.
Thanks, Chair. Can I just ask about the small business rate relief? In the draft budget, there's £20 million set aside for that there, but there was to be a review into that. Where is that at now, or does this mean we're continuing on with it?
Yeah, it means that we're continuing on with it for a further year.
Just 1 year?
Just the 1 year, and then decisions beyond 2015-16 will be taken at a later stage.
Yeah, and where's the review at then as well?
I'm not aware.
You're not aware of the review? And then on just till the change project, or the change scheme rather, has there been any schemes brought forward for that, or what is the criteria to bring a scheme forward in that?
There haven't been any schemes brought forward yet. We'll be commissioning returns from departments on that. I think that we're looking at things that will be cross-cutting, will be preventative spending, and will generate savings going forward. So it will not be called Invest to Save, it will be an Invest to Save type projects we'll be looking for, and we'd hope to have those commissioned and exercised with departments and then factor those into the final budget, hopefully, with details on specific schemes.
The EFP think we're bringing anything forward to that themselves, do you?
Not that I'm aware of, but that doesn't mean that the final, the other side of DFP are not considering that. I'm sure they are. There's ongoing work, I think, in all departments in ways to generate savings.
That's okay. Thanks, Chair.
Okay, Paul. Let's really come back to the 133 million set aside in relation to pensions, and I just want to get this clear in my own head. Contributions could increase by employer, which comes out of our revenue again.
No, this 133 is to cover those increased employer contributions.
Okay, but that's out of our revenue then?
It is, yes.
So, as a consequence, I'm wondering, our total pension block is paid from an AMI fund, I would take it.
and as a consequence of the shortfall within that AME fund, which doesn't affect our block grant, we are then going to be knocking money out of what is our block grant to actually subsidise the pension scheme. Is there any mechanism in place to ensure that we don't have that hit? And this is something which I appreciate. The pension pot and the size of that pot is the point where it's not meeting the requirements of those that are drawing down the pension. That is not our fault, but we're going to be made to pay for it.
Pension, I'll be first of all, in case I have somebody else in DFP shouting at me for getting it badly wrong. Pension's not my area of expertise. But what happens is, as in a private sector organisation, you would have to put the money into an actual fund.
That's fine.
And build up the investment. But within our, But we also, to ensure that departments account for basically all of the resources that they use, and that includes the cost of having their employees, we build up a notional fund. And within our salary costs, there is an element of that goes to fund pensions in the future. And it is that, what they're basically saying is, the employer costs we've been paying up to now have not been great enough to fund the pensions liabilities we are building up. So although the actual pensions themselves are paid out of AME, what they're saying is that we as an executive and every other department in the UK should be meeting the ongoing costs of building up pensions for their employees. And that it's that cost they're saying has been understated. We haven't been contributing enough over the past 5, 10, whatever years. And it's that shortfall we now have to address. So had we had increased level of employer contributions over the past 5 years, then that fund would not have been valued with this deficit in it. And it would have been levelled out over that.
Yeah, I'm just appreciate that if it was in a private sector, the pension pot would be dependent upon the growth and the investment that pot was put into. As a consequence, we are at the mercy of whatever Treasury are doing with their putting it on red or whatever, or putting it on black, hoping it comes up. I'm just wondering, is there an issue here that we should be looking at? Because this is going to be a recurring cost, and if not, it might well increase, going by the reliance of public sector within the Northern Ireland economy. Are we paying percentage-wise proportionately? Is it done in proportion of the number of civil servants who are contributing into that pension pot? And
it is directly related to the employee. Our share is directly related to the costs of our employees' pensions. So it is Northern Ireland civil servants, public sector health workers.
Okay.
It is definitely.
I was just wondering how that figure had worked from over 200 million down to 133, and where that negotiation had come in.
It's all through how the Government Actuaries Department values it and what term we're making up the shortfall, and that's probably way too technical for me.
Nobody seems to know how government actuaries ever work, because we can never seem to get the information out of them. So it's
no comment.
No, I'll make that.
Okay, Raymond.
Thank you very much, Chair. In terms of the sort of public consultation process, what do you expect to see coming from that public consultation process? There's a lot of people think sometimes public consultation, it's, we pretend that we're giving the public a say, and in the end we still do the same thing that we set out. What would you like to see in the public consultation process to try and change and alter this process?
I think a key thing for us, obviously, we want to know from the public where they want the resources to be directed to, what they see as their priorities. And an important thing would also be if they're saying give more funding, say, to health or to education, if they also say which areas they think should have less funding, because obviously we have a constrained amount of money available, and if we're giving to one, we're going to take off another, so it would be very useful if they could do that.
Yeah, but say in terms of the wider process, a lot of people would say that there's an overuse of, say, professional and consultancy services. If that becomes part of the public consultation process, what steps are you able to say to our department, or is that a departmental choice?
Sorry.
What we do is whenever we get the responses from consultation in, we will compile them and put them under sort of key headings, and then we provide that to the executive. as part of the final budget for their consideration. Now, the last time round, a number of changes happened as a direct result of consultation, including additional funding for the arts, because there was a big consultation response in that area. The changes as a direct result of consultation were published as part of the final budget the last time round, and I expect the same to happen this time.
And in terms, I mean, I think the Minister referred to this both in October, possibly more in the budget. Is there going to be a special monitoring process put in for where people are getting additional money, that it's spent in the way which, say, the executive intends?
Well, certainly if the executive allocate money for specific things, we will be making sure that departments spend it on those specific areas.
Okay. But is there any other mechanism being put in just to say, like, now money's so sort of scarce, we need an extra observation that money's been spent in a particular way? And what's sort of in my head, like, is in the past, a lot of speculation at present about the college, in Desert Creek. They have presented to the Justice Committee, which I'm a member of, massive mistakes made, a lot of money lost to the public purse, and people will be asking, if we take our projects forward, what are we going to put in place to make sure that that's not repeated? But particularly when £20 million, if that's the amount, it might not be that, but if that amount of money is being lost at a time when people are seeing frontline services being tacked, or undermined by sums of £1 million could make a difference here and a difference there. So how do we guarantee that that isn't going to be the case in the future?
I don't think there's any plans, certainly that I'm aware of, to put any additional layers of scrutiny in at the moment. There are already very good controls in place, obviously sometimes maybe not working as well as what they should, but I think it's maybe stepping up the existing ways of monitoring it. And it's maybe something that needs to be considered, but I'm not aware of any plans at the moment.
Yeah. And overall, when the consultation process is finished, will there be a quality impact assessment carried out on the proposals?
There would be, what we're doing is we're doing a high-level screening document in line with the Equality Commission's guidance. We've been liaising with them closely as to how we go about that. That will be published as part of on top of the draft budget in a number of weeks' time whenever we get the information back from departments. In addition, we would expect departments to adhere to their own equality schemes and publish equality impact assessments on detailed policies and proposals that they would come up with.
So it will be a combination of both?
It's a combination of both, yes.
Okay, thank you. Thank you.
President?
Thanks, Chair. The 872 million shortfall, did that come as a surprise to the department? When would they first become aware of the 872 million shortfall for 15-16 budget?
I'd say that we've been aware, and we've been making departments aware for some time, that there are pressures emerging in 15-16 that'd be considerable pressures, and departments would need to face considerable reductions. Now, the 872 was not actually a shortfall as such, because the vast majority of that was allocated back to departments. What it did do was allow the executive to provide fundings to priority areas. But we have been warning departments for some time. There's significant reductions.
It's just I don't recall us being advised of this, prior to June. But there was this big change coming down the track.
I'm afraid I'm probably not best placed to comment what was before June, but I think certainly.
Certainly, there have been a number of issues that the executive have crystallised in recent months that would develop that 872. We would never have been in a position back in June to be able to tell you what a draft budget, what the total extent of pressures would be at that stage, but certainly that would have crystallised in the last number of months.
Certainly come as a surprise to us, and I think to most other people. The baseline the Minister refers to, that it's yet to be distributed. How big, in fact, was that baseline at for the start of the year?
In which way? The starting point of the
yes,
budget?
Which is the end of this current year, yeah.
Yeah, what we basically did to construct the baseline was we rolled the 14-15 opening monitoring position forward into departments, and then we removed certain time-bounded allocations, things like the Jobs and Economy initiative, things that were allocated for a specific purpose in a specific year. That formed the department's starting point, and then it was to that the reductions were applied, and then to that point that further allocations.
Would there be any EU outstanding monies or any Barnett consequential still pending?
all the Barnett consequences we have at the moment have been factored into that position. Obviously, the Chancellor has his autumn statement coming up in the beginning of December. There may be something emerging from that. I wouldn't imagine it would be anything large, but that will be factored in then to the final budget position. In terms of EU funding, the EU match funding we hold centrally at the moment will be allocated out for the final budget. So that is still to be factored into departmental position as well.
So the beginning December figure will be finite, that'll be it, will it?
It will be, yes. Unless there's any changes, obviously, in the next.
On the pensions one, if we just quickly fly back to that, I know you said you're not just too happy with being in that area, but because it's a revenue stream, really, was there ever a minimum funding requirement established for the scheme, as there was in private sector scheme?
Well, I'm not sure when the last revaluation of the scheme occurred, but my understanding is that when the revaluation of the scheme occurs on a periodic basis, that determines what the level of contributions will be over the incoming period.
Is it possible to find that out if there was a minimum funding requirement?
Yes, certainly.
That would be helpful. And the last one, Chair, if we could ask just about the sale of assets. You know, we have a new department been set up. It's going to cost in the region of 50 million. What I can read here. What sort of asset sales have we had over the last year?
I'm afraid I don't have the figures with me at the moment. We can certainly get those, but there are, asset sales generated on a year-on-year basis. There are capital receipts coming in. I can certainly get you figures over the past few years if you'd like to see those.
Because that would be a little bit of a bonus, wouldn't it?
Yes, anything additional we can generate in terms of capital receipts would obviously be a bonus. As I say, we have factored
Not in
in.
here at the moment then.
Well, with 50 million factored in for anticipated asset sales,
Yeah,
we
but
have factored in additional.
But the cost for this new department is
It's
going
not. It's not a new department. The asset management unit exists.
Yeah, no, it's a new look department then.
Well, it has existed, I think, since the time of the last budget. And they have been working with departments on an ongoing basis. They're part of the Strategic Investment Board, and they have been working with departments on an ongoing basis.
We had some people here talking recently about this new system operating. But anyway, I'll not labour that point at this stage. Could I make just one last point? 11.7% of the overall capital spend next year is going to come from FTC.
Yes.
And just looking at the Minister's comments about the investment fund, he says may utilise monies from that. Could we know definitively? Certainly, I need to know, really without any more time being wasted on it, what other system we can put in, what process we can put in to maximise this. At the moment, there is no scheme. I see it. No proper process so that we can harness all of this financial transactions capital. If the investment fund isn't able to cope with all of that, and it does seem a bit utopian, it may not happen, we need some other way of utilising that money which is coming outside the Barnett formula.
Yeah, you're right, there's no overarching scheme, but every department has been tasked with identifying ways in which to use this funding. The investment fund will hopefully be an overarching scheme. We won't know with any certainty until a feasibility study and that is completed what levels of funding it will require and how we will utilise that. Hopefully that work will be completed over the coming months.
But we actually had money returned, I think, by DETI, didn't they? Return some 5 million?
They did return some 5
So
million.
it shows that obviously it's not working yet.
Well, obviously that scheme, there have been delays in or not working as it should have been. It's a new funding stream and yes, there are teething issues with it and we need to get departments on board to identify projects that are suitable for it.
We are hopeful to spend the remaining funding that is available or is still not allocated in 2014-15. There are a number of schemes out there that may be able to utilise that, and we're in negotiations with departments on that. So we're hopeful that we will not lose money to Treasury this year.
But it's really up against it now with 35 million there unallocated.
Yes.
Okay, thanks, Chair.
In terms of the workforce restructuring plan, and it says that it will embrace all possible personnel interventions, recruitment freeze, addressing vacancies, use of temporary staff, pay restraint and voluntary exit mechanism to reduce workforce numbers. Would that include reducing public servants' contracted hours and even pay cuts as alternatives to redundancies?
Corporate HR are working through that scheme with departments at the moment. I don't have any details of it, but I would imagine that every possibility will be considered.
And is there any indications you know, what options you're looking at in terms of that? You must have a broad idea.
Broad idea, I think they're working on a paper at the minute to go with the executive within the next 2 weeks, which will detail what they're doing on that.
In terms of the Department of Finance and Personnel itself, I mean, obviously there's a 10.9% reduction. What are the options being looked at within the department specifically?
I'm going to look back to my line because obviously not our area as such, but I have been. It is going to be challenging for the department. What they've told me is that it's a major cut to the current expenditure totaling 17 million. Further reductions of 8 million will also be required to enable them to fund inflationary pressures in pay and prices and new priorities arising since the previous budget period. Part of the early planning work, the department had identified a long list of savings, and the departmental board agreed in March to put in plans in motion to deliver a reduction of 4%. There were also contingency plans identified should the reduction of 8% be required. Obviously, the 10.9% is significantly in excess of what they were planning for, and it's going to be challenging to the department to deliver. So they've set up an internal project team representing all directorates to conduct an internal review of DFP's budget, and the aim of that is to identify opportunities for savings and for generating additional revenue, not only within individual business areas, but those that cut across DFP. And they're also hoping to find opportunities to reduce costs at an NICS-wide level during the process. So basically the work is ongoing to identify where to make savings within the department.
But you said there was a plan in place, savings plan for 4%, contingency of 8%.
Yes.
You know, so what were you looking at for those plans?
It's not my area, so I don't know in detail what they were actually looking at.
You may not know in detail, but do you have a rough idea?
No, I'll be honest, no.
What about you, Jeff?
No, I'm not aware of the specifics of it. I mean, I'd imagine that the department will have to be looking at a range of measures around cutting costs for delivering services through shared services and that sort of thing. But one of our key areas of spend, so therefore we'd have to be trying to make savings within it.
Okay, any other members? Happy enough. In terms just of the timeline, I am concerned that it is quite tight, and I know other committees will be and have been making some noises that it is quite tight. Is there a possibility that that could be delayed by a week or two to ensure that we get a proper and fulsome response?
I don't think it's within our remit to delay it by a week or two.
Yeah.
It would be a matter for the executive to decide if they wanted to push it back.
Fair enough. Okay, thank you. Members, just on that final point, could I suggest that we write formally to the Minister to request some additional time, even until the committee's scheduled meeting on the 7th of January, to provide the coordinated report in response to the draft budget? Agreed. Okay, can I seek agreement to write to other statutory committees asking for inputs to the coordinated report and also to provide them with the Assembly research paper to assist their scrutiny? Agreed. Can I also seek agreement to forward the Assembly research lines of question paper to DFP for a written response to any issues not addressed during today's session? Agreed. Okay, any other business? No. Next meeting will be Wednesday, 12th of November, 10 a.m. 1:30.
Is the Northern Ireland Assembly Committee Room 30. This is the Northern Ireland Assembly